So you've been investing in mutual funds. You're seeing some great returns, which is awesome. But have you stopped to think about how much of that profit is actually yours to keep and how much you owe the taxman? Today, we are going to pull back the curtain on mutual fund taxes in India so you can plan smarter and hold on to more of your hard-earned money.
Look, you've already done the tough part, saving and investing. But the game isn't over when you sell. That's when taxes come into play, and you definitely don't want any nasty surprises. So let's make sure you know exactly what's coming.
All right, here's our game plan. First, we're going to talk about why you can't ignore this stuff. Spoiler alert, you're being watched. Then we'll break down the rules for equity, debt, and hybrid funds, one by one. After that, we'll get into a really cool topic, how to actually use your losses to your advantage. And to wrap it all up, I'll give you a super handy cheat sheet. Sound good? Let's go.
Okay, let's kick things off with a fundamental truth of investing today. Big Brother is watching. I mean, the tax authorities, they literally see everything.
Yep, you heard that right. It doesn't matter if you buy or sell just one unit of a mutual fund for 100 rupees. Every single transaction gets automatically reported to the tax department by agencies like CAMS and KFintech.
And where does all this data go? Well, it pops right up in your annual information statement, the AIS, on the income tax portal. So the idea of just forgetting to report a transaction, that's not really an option anymore. And here's the kicker. This is really important. This applies even when you lose money. You have to report your losses in your tax return. And trust me, in a minute, you'll see why that's actually a fantastic thing for you. All right, let's dive into the nitty-gritty, starting with everyone's favorite, equity funds. Now, for a fund to be called an equity fund for tax purposes, it's pretty simple. It just has to invest over 65% of its assets in Indian stocks. Now, with equity funds, the single most important factor is how long you hold on to your investment. As you can see right here, if you sell in under a year, it's a short-term capital gain. But if you hold on for more than a year, it becomes a long-term capital gain. And that little distinction, it makes a massive difference to your tax bill. For those short-term gains, anything less than a year, the math is dead simple. It's a flat 20% tax on your profit. It doesn't matter what your income is or what tax slab you're in, just a straight 20%. But this is where patience pays off. For your long-term gains, the first 1,25,000 rupees you make in a financial year is completely tax-free, zero tax. You only pay a 12.5% tax on the profit above that exemption. That's a huge incentive to stay invested, right? Okay, next up, debt funds. And I need you to pay really close attention here because on April 1st, 2023, the rulebook for these was completely thrown out the window. This slide says it all. You see, it used to be that if you held a debt fund long-term, you got this awesome benefit called indexation. It basically adjusted your buying price for inflation, so you paid less tax. Well, as you can see under the new rule, that's gone. Poof, vanished for any new investments. So what's the new reality? Honestly, this is the easiest way to remember it. Any profit you make from a debt fund you bought after that deadline is now taxed exactly like your bank's fixed deposit. It just gets added to your total income for the year and taxed at whatever your slab rate is. The old advantage is gone.
So we've talked about pure equity and pure debt. But what about the funds that sit in the middle? Let's get into hybrid funds, because they have their own unique set of rules.
For hybrid funds, the first thing to notice is the holding period. It's not 1 year like equity. To qualify for long-term gains, you have to hold them for more than 2 years. Sell before that, and any profit gets taxed at your personal income tax slab rate. But if you hold on past the 2-year mark, it's a flat 12.5% tax. Now, listen up, because this is a classic mistake people make. That lovely 1,25,000 tax-free exemption we just celebrated for equity funds, yeah, that doesn't apply here. With hybrid funds, your entire long-term gain is taxable from the very first rupee. It's a critical difference. Okay, investing isn't always a straight line up. Sometimes you have losses. But here's the thing. A loss isn't just a loss. It's actually a powerful tool that you can legally use to lower your tax bill. And this is why reporting them is so important. Think of a short-term capital loss as your most valuable player. It's super flexible. As you can see, you can use it to cancel out profits from your short-term gains and your long-term gains. It's a great way to slash your overall taxable profit. But, and this is a big but, a long-term loss is much more restrictive. It's a specialist. You can only use a long-term loss to offset a long-term gain. You can't use it to touch any of your short-term profits. Remembering that one rule can save you a lot of headache.
And here's the best part. What if you have a big loss and not enough gains this year to use it all up? No worries. The benefit doesn't expire. You can actually carry those leftover losses forward for up to 8 years to use against future gains. You just have to make sure you file your taxes on time.
Whew, okay, we have covered a ton of ground. Different funds, different timelines, different rates. So let's boil it all down into one simple final cheat sheet that you can refer back to. Okay, rapid fire. For equity, under 1 year is 20%. Over 1 year, it's 12.5% on gains over 1.25 lakhs. For new debt funds, it's easy, taxed at your slab rate. For hybrid, remember the 2-year mark. After that, it's 12.5% with no exemption. Any dividends you get are also taxed at your slab rate. You can carry forward losses for 8 years. And finally, for your SIPs, they always use the first in, first out method to calculate your gains.
So there it is. That's the complete playbook for mutual fund taxes in India. But understanding this stuff isn't just about compliance. It's about being a smarter investor. So the question isn't just what are the rules anymore. The real question is, now that you know them, how will you plan your exits to make them work for you?